Hey everyone, welcome to Learning Options in 4 minutes or less. And today we want to take a look at a very simple but very important concept. And this is the concept of buying a call option. And we're going to accomplish two things. First of all, we will teach you why you would want to use a call option. And secondly, when. And believe it or not, those are actually two different questions. So let's have a look at the most important bit here, which is, why would you use a call option? And in order to do that, let's quickly have a look at our payoff diagram of a call option. So when you buy a call option, same thing for a put option, by the way, but in this case, we're looking at call options. When you buy a call option, you have an outlay of cash. It's going to cost you some money to have the optionality, the right to buy a certain underlying asset, be that a stock or something else at a certain point in the future. And so when you enter that agreement, or that right, you have a debit basically. And you can see in this case, the example is that it costs you $500 to get into that contract, which is to say that the stock that you're looking at ultimately has to move a certain percentage point to the upside by expiration. At the latest, in order for you to make money, and the amount that it has to move up is exactly equal to the premium that you pay. And you can look at this payoff diagram. I think it shows it very clearly. You can see in this case it costs you $5, i.e. $500 to buy the contract, which means that from the point where you buy it, which at the time the underlying asset was at $100, it had to move up to $105 at expiration until you could start making money. Now, the sooner the stock does move up, or whatever the underlying asset is, the quicker you'll make money. So that's the payoff diagram, and I want you to really think about this. Maybe rewind this tape and watch this again. But the reason why one would use a call option primarily has to do with leverage, gaining leverage, meaning if you were to make, let's say, 10, 15, 20% on an underlying stock, if the option were to move up quick enough, you should be able to make 50, 100, maybe 200% return on that. But that's really the why. At the end of the day, it's leverage. Some people would argue there's a risk management part of it as well that makes sense to use call options, but really it comes down to leverage. So that's the why. The other part we want to quickly address is the when. And the when is one of those things that I think is very misunderstood. So a lot of people think you just buy a call option and wait it out and wait for the stock to go higher, if that's your thesis. For the most part, actually, what we know, unfortunately, is that most call options that are held to expiration expire worthless. So you have about an 80% chance of losing money if you try to do that. So the when you would use a call option is basically when you have a specific time in place when you think something will happen to propel that stock higher. You don't want to wait too long because options do work against you in terms of time. So when you do get into call options, make sure you have a specific date in mind by which you either expect something to happen or not happen, and that'll be sort of your time stop, if you will. So that's really important. Make sure there's a time catalyst that's included in your thesis. Hope this is helpful. We'll see you in the next video.